In today's gold market update, we are focusing on the latest fundamental picture and what it means for your trading and investing decisions. Let's begin with the macro environment. The U.S. economy is cooling, with first quarter GDP showing a slight contraction and inflation moderating around 2.6%. The Federal Reserve is currently on hold, keeping rates between 4.25 and 4.5%, but stagflation risks are emerging. In the Eurozone, growth remains modest at 0.4% for the quarter, and inflation has eased close to the European Central Bank's 2% target. The ECB has started cutting rates, now down to 2.75%, supporting a dovish trend. China posted strong 5.4% GDP growth year-on-year, but deflationary pressures and U.S. tariffs are darkening the outlook. The People's Bank of China is in easing mode, and more cuts are likely. Now turning to central bank policies. The Fed is maintaining a hawkish hold, though markets expect rate cuts by late 2025. The ECB continues with gradual easing, and the PBOC is set to provide further liquidity to counter weak domestic demand. On the geopolitical front, safe haven demand remains robust, the ongoing Russia-Ukraine conflict, rising U.S. China trade tensions, and policy uncertainty from the Trump administration all continue to drive investors towards gold. Importantly, central banks worldwide are increasing their gold reserves to diversify away from the U.S. dollar. Let's look at physical demand and supply. Central bank purchases were solid at around 244 tons last quarter. Investor demand surged, with ETFs adding over 226 tons and strong bar and coin buying, especially in China. Jewelry demand, however, dropped by about 21% as high prices deterred buyers in India and China. On the supply side, mine production was stable, with a slight increase of 0.4%, and while recycling activity remained steady. In the currency and interest rate space, the U.S. dollar has weakened by around 4% year-to-date, making gold more attractive. Real interest rates are holding around 1%, but the trend is flattening, which supports gold's appeal. Key regulatory developments include new U.S. tariffs, which are raising inflation fears and sustaining gold's hedge value. India's decision to maintain a lower gold import duty is also boosting retail demand. Meanwhile, sanctions on Russian gold continue to reroute global trade flows without major disruptions so far. So, what's the conclusion? Gold's fundamental backdrop remains strong. Central bank and investor demand is robust. Monetary easing is spreading globally, and geopolitical risks keep safe haven flows alive. Jewelry demand is weak for now, but could recover if prices stabilize. The key headwinds to watch are potential trade war resolutions and unexpected drops in inflation, which could slow gold's momentum. Looking ahead, in the short term, expect choppy consolidation with an upside bias. Finding dips near strong support zones around the $3,000 mark offers tactical opportunities. In the medium term, the outlook remains bullish. We see potential for gold to retest and possibly exceed $3,200 to $3,100 by year-end, especially if rate cuts and geopolitical tensions persist. For risk management, keep a close eye on Fed signals, trade negotiations, and ETF flows. In summary, the gold market remains well supported, with opportunities for both traders and long-term investors to capitalize on prevailing trends. Stay tuned for more updates and trade wisely.